Brace yourself for the next 90 seconds. What's unfolding right now could redefine global liquidity as we know it. In the span of a single trading day, markets convulsed. Stocks dumped, gold spiked, and XRP, the asset built to settle value in seconds, whipped from $150 to just over $2 before most people even refreshed their charts. To the untrained eye, it looked like panic. But beneath that chaos, the next phase of the ETF liquidity cycle just switched on. This wasn't a crash. It was a stress test of the new financial circuitry. Quick note before we dive in. Make sure you like and subscribe right now so you don't miss the next critical drop that exposes how the money system is rewiring itself in real time. It helps push this message to the masses, and every subscriber here is part of the Matrix movement, the group that spots truth before the mainstream catches up. This is not financial advice. Always do your own research and consult a qualified professional before making any financial decisions. At the time of recording, XRP is trading around $2.05. If you're watching later, that number may have shifted. What matters isn't the quote. It's what the quote is telling you. Here's the bigger picture. When Trump announced sweeping new tariffs on Chinese imports, it detonated a chain reaction across every liquidity corridor on Earth. Equities sold off, bond yields slid, gold futures spiked to multi-month highs, and somewhere in that crossfire, exchange algorithms started pulling liquidity from risk markets and redeploying it through tokenized settlement rails. That's when XRP lit up, the moment the old system touched the new. Behind the scenes, institutional desks and ETF creation agents had already begun their quarterly rebalances. When tariffs hit, they accelerated those adjustments. Billions in fund baskets were unwound, their cash legs racing to find instantaneous settlement. Legacy pipes can't handle that speed, but blockchain rails can. For a few minutes, the world's liquidity literally pulsed through RippleNet-connected corridors, testing how fast modern finance can move. That's why XRP collapsed and rebounded like a rubber band. The system was measuring its own throughput. What you just witnessed was the digital equivalent of a central bank stress drill. They wanted to know, can cross-border settlement handle ETF-level order flow under pressure? Answer yes, and faster than expected. For older investors who've lived through market shocks, the dot-com crash, the credit crisis, the pandemic panic, you know that volatility often precedes adoption. Each wave of fear forced innovation, circuit breakers, ETFs, quant funds. This time, the innovation isn't regulation, it's integration, bridging traditional liquidity with on-chain settlement. Gold and bond ETFs are the quiet engines of that bridge. Every rebalance transfers massive liquidity between safe and risk assets. Yesterday, that current finally began flowing through blockchain rails instead of overnight clearinghouses. That's the signal institutions were waiting for. And if you're holding XRP, you're literally sitting on the infrastructure absorbing that flow. Let's be clear, this wasn't retail capitulation, it was institutional calibration. Machines did it, not mobs. Algorithms repriced risk to account for real-time settlement capabilities. When the dust cleared, XRP was right back where it started, but ownership had quietly shifted upstream. And that brings us to the truth no one on CNBC will say out loud, volatility is the price of integration. The old financial system is being plugged into the new one asset by asset, corridor by corridor. Each time it sinks, it shakes. That's not a sign of failure, it's a sign of life. So when you hear the market crashed, translate it correctly. Liquidity moved, it didn't vanish. It simply took a shortcut through a faster pipe. And every time it does, XRP's utility score ticks higher. Key point to pay attention to. If your portfolio includes stocks, bonds, gold, or XRP, what you're seeing right now could determine how much of it you still own after the next liquidity event. Because these aren't crashes anymore. They're handoffs between eras. When you strip away the headlines, what really drives these violent moves isn't fear. It's mechanics. Every ETF, whether it tracks gold, bonds, or equities, operates through a creation and redemption engine. When markets shake, authorized participants dissolve or rebuild those baskets in real time, freeing or absorbing billions of dollars in liquidity. In the legacy world, that capital would sit in clearing limbo for days. But in this new phase, that idle cash is instantly looking for a faster rail. That's where XRP's settlement corridors come in. Picture a series of valves connecting traditional finance to on-chain liquidity. When one valve, say the bond market, closes slightly because yields rise, another valve, maybe gold or digital settlement, opens to maintain pressure. Yesterday's shock showed those valves sinking for the first time. Capital didn't leak out of the system. It rerouted through tokenized corridors designed for millisecond settlement. Now, a lot of people ask me where I actually track these moves in real time, because when liquidity rotates this fast, you can't rely on delayed charts or headlines. Honestly, I use MEXC. It's where I can literally see institutional liquidity shifts the moment they happen. I'm not sponsored. It's just the most transparent exchange I've found for watching these flows. I use it daily because it shows how money actually moves between pairs, not just price candles. If you want to follow along, the link is in the description of this video. No pressure. It's simply the tool that helps me stay one step ahead of the curve. Back to the mechanism. When ETF desks free up cash, that liquidity seeks immediate yield or settlement utility. Stablecoins handle part of it, but institutions need deeper rails that can move value across jurisdictions, bypass time zones, and finalize instantly. RippleNet and the XRP ledger do exactly that. So as gold ETFs expanded their positions while equity ETFs reduced risk, the capital bridge between those funds pulsed through XRP's architecture. The sudden spike in throughput wasn't random. It was a live-fire rehearsal of a world where fund rebalancing no longer waits for T+1 settlement. Think about that. The entire structure of Wall Street's liquidity cycle is built on delay. Overnight risk, daylight overdrafts, collateral chains. The moment you remove that delay, everything reprices. Speed becomes safety, not risk. XRP represents that speed. The volatility you saw, those wild candles between 150 and 2, wasn't weakness. It was the plumbing breathing under new pressure. Liquidity moved so quickly that order books literally thinned out between exchanges. Within minutes, algorithms recalibrated and filled the void. That's not panic. That's coordination at machine speed. Now pay attention for the next 30 seconds because here's the truth. You can't outtrade institutional algorithms, but you can out-understand them. Once you grasp how these flows move, volatility stops being a threat and becomes proof the system is alive. If you're enjoying this content, make sure you like and subscribe. It really helps spread this message to the masses and keeps this movement growing before the rest of the world catches up. Here's the uncomfortable truth about markets. They run on emotion, but they're controlled by structure. Retail investors move on fear, institutions move on flow. And if you don't understand that difference, every sharp candle looks like disaster instead of opportunity. When XRP plunged to 150, it wasn't panic selling, it was whales changing lanes. Picture the market as a one-lane bridge. When a convoy of heavy institutional trucks starts crossing, the smaller cars, the retail traders, have to pull aside. Price dips, the road looks congested, and social media fills with panic. But when those trucks finish crossing, the bridge clears, and price snaps right back. That's exactly what happened. Exchange supply tells the story. The amount of XRP held on public exchanges is shrinking to levels we haven't seen in years. Custodial firms, the same entities that hold ETF collateral and manage institutional treasuries, are moving XRP into deep, cold storage. When that happens, every trade on public order books carries more impact. That's why even a few million in algorithmic orders can move the chart so violently. Retail traders see that motion and assume manipulation. But whales aren't trying to trick anyone. They're optimizing corridors. They move liquidity where settlement costs are lowest and throughput is highest. When ETF desks redeem baskets or shift gold exposure, whales rebalance those same flows on the crypto side, keeping the global liquidity cycle in equilibrium. That's why volatility is your teacher, not your enemy. Every red candle reveals which corridors are live, which exchanges are liquid, and where the system still bottlenecks. Each spike and crash is data, and the smartest investors, the disciplined, patient ones, are treating these shocks like early access to how the future settlement grid will behave under pressure. Look at the psychology in play. Retail hears tariffs and dumps risk. Institutions hear trade friction and see an opportunity to accumulate neutral bridge assets that thrive when global trust breaks down. That's the divergence. Fear versus preparation. Noise versus understanding. You've seen this before. In the gold markets of the 1970s. In the ETF revolution of the 2000s. In every instance, early volatility scared people away just before structural adoption made them wish they'd held. This cycle is the same. It's just happening faster because now the infrastructure runs on code instead of phone calls. Watch this. Every red candle isn't destruction, it's calibration. The system is adjusting its lungs, expanding and contracting as it learns to breathe in real time. And the few who recognize that rhythm, who can feel the pattern beneath the panic, are the ones who will still be holding when the rails go live. So don't let short-term emotion blind you to long-term logic. The whales aren't fighting you, they're showing you where the corridors are forming. Every flash crash and rebound is a signpost on the road to institutional dominance. Stay with me, because in the next 60 seconds, we're zooming out to the macro level, where you'll see how gold, bonds, and XRP are fusing into one synchronized liquidity network, and why that shift could permanently reprice what XRP is truly worth. Zoom out for a moment. Interest rates have peaked, inflation is cooling, and global liquidity is shifting from defense to movement. When that happens, capital leaves safety and looks for velocity. And for the first time, that velocity lives on-chain. Gold has already flashed the signal. Bond yields confirm it. Every rebalance now passes through digital corridors, and XRP is the bridge connecting them. It doesn't compete with gold or ETFs, it links them into one synchronized network where value never sleeps. The tariff shock didn't break the market, it exposed its evolution. Liquidity didn't vanish, it migrated. The same way the dollar became the bridge after Bretton Woods, XRP is becoming the bridge for tokenized trade. For seasoned investors, this feels familiar. Every financial revolution starts messy, then stabilizes. That volatility you just saw, it's the calibration phase before adoption. When central banks ease again and liquidity surges, the rails that can settle instantly will dominate. And XRP already proved it can take that weight. So when the next headline screams crisis, remember, markets aren't collapsing, they're upgrading. Each move is the system sinking faster, tighter, cleaner. Strap in, because the next XRP surge won't be a warning. It'll be confirmation that the global settlement network is alive and online. If you believe in truth over noise, make sure you like and subscribe right now. Every subscriber here isn't just watching history. You're part of the awakening of the Matrix movement. See you on the next one, my friends.